And we're back with lesson 3 of options from orangequant.com. I'm Dennis Hudson. And we left off in lesson 2 with wondering, is it possible to lose money on puts and calls at the same time? And the reason that I raised that issue is because by then you must have noted that there's good leverage in the, an inherent leverage in an options contract. And therefore, it must have occurred to you to put on what's called a straddle, which is to buy puts and calls at the same time. So now you know that you could lose on both. And again, what is happening here is that because the underlying is moving so slowly in one direction, there's no volatility. But at the same time, time is running out, so your time decay, your theta, is eating into the value of your options contract. Now, some people do very well with straddles, I have to say, but I also have to say I don't particularly like them. I don't like what's complicated, or maybe it's just because I'm not terrifically good at straddles. And I'm also spoiled by H205 and FLIR 2 in that very often, or most of the time, I can correctly forecast the direction of the underlying. Now let's talk briefly about how you buy an option contract, what contracts to buy, and how to get ready for that, okay? Now, before we look at some option price charts, you're going to have to be enabled to trade options. Just look around your broker's site. There's a form there somewhere that you have to fill out and either mail or fax back to them. It basically says you don't mind losing the farm. Real simple form. Option prices that we're going to be looking at. You'll see prices where a contract costs, say, a nickel or 3 cents. That's not exactly true. Remember, you're being quoted, when you see that, you're being quoted at the single, as if you were able to buy or sell a single share. It's really 100 times what you're looking at because your contract is for 100 shares. So if you see, for example, a contract that's selling for 3 cents, it means it's going to cost you $3 plus your broker's fee, whatever that normal fee is, plus there'll be a per contract fee. So you want to add all this up and get some idea what that's going to cost you. And for what it's worth, I use TradeKing.com. They seem to have good service and best prices that I've been able to find. But do your own research, I'm sure you will. Now, your symbols, and we're going to be looking at those shortly. Right now, they're 5 letters. And the first 3 letters represent the underlying, and it could be anything. It might not even be, for example, let's say you were looking at Intel, which the symbol is INTC. I don't know what the option contract would look like for that, but the first 3 letters might not have anything to do with INTC. The last 2 letters specify the expiration month and the price. The expiration month and the strike price. After February 12th of this year, 2010, they're going to a 21-character option symbol to make it easier for everybody, and that will include, in pretty plain language, the strike price, the underlying symbol, and the expiration month. Now, one of the other nice things about options is that they settle the next trading day. If you close your contract today, then the cash will be available to you tomorrow, or whatever the next trading day is. The day trader rule does apply to options. Be careful of that, because it's easy to forget. But the day trader rule does apply. So if you're executing more than 3 round trips in any 5-day period, you could get hit with a day trader notice and have to put up $25,000. And you don't want to do that, probably. Also, some brokers don't even have an options platform, so you can't trade options with them. You'll have to find one that does. And while you're busy doing that, make sure that your next broker has available where you can put in your own code for indicators, your custom indicators. Because that way you'll be able to make best use of the FLIR 2 ebook. One of those indicators, H205, I use in Thinkorswim. You could either use Thinkorswim, or if your broker uses some other code language, MQL4, you could try that. Now you can get your options quotes either from your broker. There'll be a place to get a quote there. Or you can go out, say, to NASDAQ.com or finance.yahoo.com or any number of other sites, and bring up the stock, and then in the left-hand margin at Yahoo, finance.yahoo, you will see a place to pull up the options chain. Here at NASDAQ, it says options chain. I think at Yahoo it says options. That's all it says. So I'm going to click on, this is Apple we're looking at, I'm going to click on the option chain and take us to, what it'll do by default is take us to this month's contracts. Let's see what it brought us here. Yep, it has brought us to the, as you can see up there, I told you before, watch these, which month you're in up here when you're selecting your contract. We're in February 2010. And these are the calls, some of the calls, and a quick run through of what this all means. You can see a left-hand column. It says February 20, 2010. What that means is the expiration date is February 20 of the year 2010. The 20th of February is a Saturday, and you recall I said it's the Saturday following the third Friday. So really, you might figure expiration is February 19th, which is a Friday. The next column is the last price at which the contract traded, and that number means, let's take this one here, right here up where you have the division between the shaded area and the white area. That says 987. What that means is $987. And on this particular style of chart, the next number after 987, you see a minus 433. It means that's the amount it's lost since the last session. The next figure is the bid, $9.75. The next is the ask, $9.95. Remember, that means $975 or $995. The next numbers across 21413. I believe that's open interest. Let me see here. No, that's the volume, the traded volume. The open interest is, well, it's a little complex to explain, 23297. That's the contract still outstanding. And the last number, the one that's probably most important to us, is this $200 number over here. That means that's the strike price. Okay, I see our 10-minute clock is running down. In the next video, we're going to talk about what's the difference between the shaded area and the white area. One means in the money, one is still out of the money.